Hello again, everybody. This is Matthew Guerra from Seacoast Mortgage discussing learning the mortgage process. Now, if you remember in the previous video, we did conventional mortgages, and if you're watching the videos out of order, you may want to go back to the conventional mortgage to see where we got some of our information from, as I don't want to repeat too much in this video, or at least I'll gloss over it. I'm Matthew Guerra with Seacoast Mortgage. My phone number is 401-640-3364, and my email is mguerra@seacoastmortgage.com. And I refer to a PowerPoint presentation throughout my videos, and if you'd like a copy of that, just email me and I will send it to you, no questions asked. So today we're going to do the FHA mortgage. The Federal Housing Authority is the one who puts this on. It's a government product, and it's a very interesting mortgage. And it allows people generally who couldn't get into a house with a conventional mortgage to get into a house. An FHA loan can be used on an owner-occupied 1 through 4 unit building. There's no penalty for going 2, 3, or 4. You just may need to have a few dollars down in your bank account to show that you can afford the payment in the event that your tenants were to leave. You do get a low interest rate. The FHA loans are more forgiving of lower credit scores, and you can go up to a 56.9% debt-to-income ratio. That compares to 45% on a conventional product. The cons is you cannot use an FHA loan on investor property. You must be owner-occupied. There's mortgage insurance for the life of the loan. The exception to that is if you have 10% down. But generally speaking, you're looking at mortgage insurance for the life of the loan. The FHA guidelines can be picky about conditions of the house, which means you need to have handrails, no peeling paint, nothing like that. They want a good conditioned house. It's a house that the government would want to insure. You also have to pay an upfront mortgage insurance premium of 1.75% of the purchase price of the house. That's a tough one to swallow. No, I'm sorry, it's not the purchase price, it's the loan amount. So the mortgage insurance premium for life goes into that bucket that you see in the bottom left. The upfront mortgage insurance goes into that bucket on the left, and that bucket is so the government has a big pile of money they can use to bail out the banks or themselves when people default on loans, specifically the FHA loans. So now the question is, how do you figure out how much a house is worth? How much it's going to cost you? Now, if you remember, we looked at purchasing this particular house in Tiverton, and we said, well, how can we get a loan on a conventional product? Now let's go with an FHA. Let's say we're going to buy an FHA loan on this house. So let's get out our spreadsheet, and if you want to see where the numbers came from, then on the left column, check out my previous video. But we're going to do an FHA mortgage right now. Now, the purchase price is still $149,000, so we'll just drag that to the right. That's no change. The down payment, however, is 3.5%. On an FHA loan, you need to put 3.5% down. If you're interested in zero money down loans, there will be a video I'll post on Rhode Island housing, and I'll explain how you can get into a house zero money down. But for now, we're doing 3.5%, 0.035, times the purchase price of the house. So your down payment is $5,215. Now you'll notice that the down payment is actually smaller, which makes sense, than your conventional mortgage. Right now, a good credit score will get you 3.5% on an FHA product. That's good news. Upfront MI, remember what it was 1.75% of the amount of your loan. So it's 0.0175 times, and the loan amount is going to be, remember, it's your purchase price. It's your purchase price minus your down payment. I did not put the equal sign in there, so forgive me for that. So it's going to be this minus that. And this gets paid right on closing day. So your actual loan amount, let's add another column for this, I think, another spot for it, because it'll make life a little bit easier when we do, this spreadsheet's going to get it's going to grow. So let's add another amount. It's going to be called loan amount. And the loan amount on an FHA loan is going to be, you take your purchase price, Remember, you put some money down, so it's a subtraction, but you also have to add back in this upfront MI. So your mortgage amount is going to be $146,301.24. For the purpose of the spreadsheet, I'll keep the 24 cents in. You have to come to the table with those extra 24 cents because you cannot finance change. I'm going to put one in here too, just so we have it. Just so you can see the difference. And this is not a percent, this is a dollar amount. So you can see that even though you put down a little bit, you put $2,000 fewer down, your mortgage is actually $5,000 more than on the conventional. But if you remember correctly, the interest payment on a mortgage is, again, you take the rate, you divide by 12, because it's 3.5% over 12 months. We're going to focus on period 1 of 360, and the principal value is the loan amount. Makes it a little bit easier than what we did on the conventional product. So the interest portion of your payment is low, and that makes sense because your interest rate is lower. But the principal part is going to be quite a bit bigger. PPMT, by the way, is the actual whole payment amount, but we'll do that later when we get to our own housing. Alright, so your interest is divided by 12. Again, first payment, 360 payments total, and the principal amount is right here, and we close up the parentheses. Well, the principal payment is $230. Mortgage insurance. Now that's an interesting one. The number is always the same unless you have 10% more in it. It's 0.0085 times the loan amount, and that's for the year, so divided by 12 for each month, and you get $103.63. Now that, unlike the mortgage insurance and the conventional mortgage, which goes away after 10 years, on this product, you will have $103.63 payment every single month for 360 months, unless, of course, you refinance out of it. So now your mortgage payment, again, equals this, plus this. And remember, with the spreadsheet, it makes mortgage payments negative numbers. The insurance number is a positive number, so we'll just subtract it out to make it conform. $760.59. So it's pretty much the same payment as your conventional mortgage. The only difference is the PMI is going to stay for life on the FHA, where it will disappear in time on the conventional mortgage. We just carried over our insurance taxes, and we see our FHA mortgage saves us $7 a month for the first 10 years. It's not a bad way to fly at all. If you're looking to get into a house, that's a great way to do it. You'll have an easier time qualifying for the mortgage, and sometimes if you have a couple and you only want to put one name on, maybe one half of a spouse, an FHA mortgage is good because it will take the higher debt-to-income ratio number and apply it here. So that is how you find out the cost of an FHA mortgage. This is Matthew Guerra again with Seacoast Mortgage. And again, if you have any questions, my contact information is on the slide on the left. And I will be making plenty more videos. So hope to see you soon. Thanks. Bye-bye.